Welcome to Close of Business. I'm Alicia Barry. Global uncertainty and lagging productivity will top the list of the Labor government's challenges as it begins its second term. Speaking after his resounding win, Prime Minister Anthony Albanese said he had a warm conversation with Donald Trump and he'll continue to engage with the US President on tariffs. Rihanna Whitson reports.
Australia's economy is facing major challenges.
The immediate focus is on this global economic uncertainty.
Friend and foe has been ripping us off for years.
Fears of a US recession and a slowdown across the world, caused by Donald Trump's tariffs and trade war with China.
Businesses who are exposed to that global environment are clearly facing into very elevated levels of uncertainty.
The longer businesses delay making big decisions, investing, hiring, capital raising, then the more risk you get to what was already just a very early stage recovery here in Australia.
In Prime Minister Anthony Albanese's own electorate, firms are doing it tough.
The cost of living crisis has really bitten. People just have less money in their wallets.
Richard Adamson represents independent brewers across the nation.
They're either looking to have a freeze on headcount or lay people off, unfortunately. I'd say 50 breweries in the last 2 years that have either gone through administration or had to close.
Consumer confidence fell to a 6-month low in April, and business sentiment is showing signs of decline. Economists say with big government spending commitments, Australia needs to stop over-relying on income tax and revenue from commodities and raise taxes, including the GST.
We need to sort of get away from running structural budget deficits. That would be issue number one. And relatedly to that is the productivity outlook.
Without productivity growth, we're not lifting standard of living.
The boss of this sheet metal maker says there hasn't been enough support for his industry to innovate.
We need to do things that are going to help grow it. We need to automate. We need to do things that are going to help us be competitive on the world market, but also keep our local manufacturing growing.
A more immediate concern for Catton Industries is the US trade war with China, which is expected to lead to a flood of low-cost Chinese products in Australia.
I think people naturally always look for the cheapest price that they can get.
The trade war could also cause the closure of Chinese businesses that make vital components for manufacturers here, including packaging.
A lot of that does come out of China, so that will be really interesting to see how that progresses.
The number of economic headaches Australia faces means the honeymoon period for the second-term Albanese government is likely to be short. Forecast interest rate cuts would provide some relief in what is a gloomy outlook.
We think the bank probably needs to cut the cash rate by 100 basis points to get to something where monetary policy is neither a headwind nor a huge stimulant to the overall economy, and so we're looking for them to cut by 50 in May and then to follow them up with a couple of 25 basis point rate cuts in July and August.
Rate cuts can't come soon enough for Ian Cubitt.
It's a big concern for everyone. We'd like everyone to have a bit more money, obviously, in their back pocket to be able to spend.
A welcome spark for an economy facing a tough grind.
Labor's landslide victory has set the government up for the real possibility of a third term with its agenda of expanding Medicare, renewable energy and housing. While that creates some winners, peak business is calling for certainty for investment, cutting red tape and a spotlight on wages policy. Here's Daniel Ziffer.
Used in fashion houses from Balenciaga to RM Williams, fabric from this Melbourne factory is destined for the catwalks.
And most days I wake up and see some emails from wherever, New York, Paris, and I could pinch myself.
Despite uncertainty caused by tariffs.
We're about to ship 1,000 metres of fabric into New York. And my client is going, I don't know whether I'm going to be cop 10% or 20%.
The two major parties offered wildly divergent policy directions on energy, wages and the US-Australia relationship. Those arguments are settled for now, but there's work to do.
Big parts of the economy, big parts of the business community are really struggling at the moment. We have enormous problems around skilling and education in the country. Our energy market and systems are not going to be fit for purpose for the years ahead.
Red flags are waving.
For the past year, the number one issue that employers have been contacting and talking to us about is redundancies. They are finding it very difficult to continue to operate at the current staffing levels that they have.
There has been a surge in companies going bust each month as high inflation, interest rates and slumping consumer confidence collided with an end to tax holidays.
The peak numbers were late last year. Early months of 2025, they've been a bit better.
Inflation is now in the Reserve Bank's target band, with the central bank almost certain to cut rates at its next meeting, and then twice more this year.
We're thinking there'll be another rate cut in May, which should help. The other thing's the cost of living support.
For business, the problems that existed last week haven't been changed by the election. Things like a high cost base, skill shortages and an uncertain trading environment all being spun into the fabric of what they've got to deal with.
Gary Reichenberg's travel company gets people flying, but he feels stuck.
Red tape. I'd like to get rid of the red tape and the cost of compliance generally.
He's got nearly 150 staff across the country, and like many business owners, he's worried about Labor's push to give more strength to worker demands.
We need to create the environment for business to want to invest rather than to be scared to invest because it's too heavily weighted the other direction.
After the election fight, a victor, setting the course for the next term.
From a business perspective, we're going to face very challenging times over the next 3 years.
Many actions that you've taken so far in this administration, sir.
With President Trump revealing new tariffs on overseas film productions, set to release a similar plan for pharmaceuticals, and who knows what else, challenges are something everyone can agree on.
4 million homes are plugged into rooftop solar. Now there are predictions of a boom in household batteries. Labor's flagship $2 billion battery scheme is promising a 30% discount for households and businesses. While the sector is set for rapid expansion, there are warnings to consumers to avoid dodgy installers. Nasim Kadem reports.
So what we have here, the iStore range, which is a hybrid inverter, and this is your battery stack underneath it.
At this solar business, orders for batteries are running hot.
The price point that the iStore products are at as compared to Tesla and BYD.
Households installing home batteries will get a 30% discount under government incentives that kick in from July.
We feel like we've hit the lottery a little bit with this one. Over the weekend, after the election, I had about 40 calls come through. So I believe that we'll be increasing our battery installations by at least 50% over the next 2 quarters.
More orders means the business will need more staff.
Generally, we look at about 3 to 4 weeks of booked out, sort of what we would call it. Now we're going to be looking at probably about 12 to 14 weeks. So we're going to need more installers to supply that demand.
With Labor now having a mandate to address climate change, investment in renewables is expected to boom.
The Australian public really supports renewable energy. It is something that if the people want and the policy is there to support it, then that makes it easier for investors to sign off on the large transactions that are required as we do shift from a mainly fossil fuel-based economy to a mainly renewable energy-based economy.
Giving companies like Engie, that owns wind and solar projects, certainty.
We aren't concerned about the rug being pulled out from under us from a policy perspective, and so we can have that reassurance that we can go ahead and make investment decisions in clean energy in Australia for the next 3, perhaps even 6 years. As you can see, obviously the numbers are looking great for us this quarter.
The multinational has big plans.
We're expanding our plans to build more wind, solar and battery projects throughout Australia and evaluating what that means for hiring and expanding teams.
In 2024, total investment in large-scale clean energy projects was $12.7 billion. That's up from $6.4 billion the previous year. Labor wants renewables to generate 82% of the nation's power by 2030.
The obstacles to a rapid transition there are huge. So I'm doubtful that the rapid emission reduction targets can be met, but policymakers and governments ought to try.
Power bills are set to rise again from July. Australia's energy regulator says prices could lift by up to almost 9% in some areas as the cost of power generation climbs. Consumers looking to cut bills could now fuel further uptake of solar and batteries.
Businesses say the high upfront costs could soon pay for itself, but warn people to be careful of shoddy operators.
It's important to vet who your installer is and also make sure that you do your research into the particular products and the batteries that you're looking to install, because there is very cheap and nasty and there is very overpriced as well.
An important piece of advice for consumers rushing to take advantage of government subsidies.
Drill, baby, drill. That was the cry from the US President Donald Trump, promising a golden age for the big oil producers. But since taking office, his chaotic tariff threats have seen the oil price plunge to a 4-year low. And that's delivering some much-needed relief to consumers here at the Bowser and the supermarket. Tony Ibrahim reports.
Inside some of these trucks are groceries and materials critical for building new homes. They travel across country and need a lot of diesel to get there.
The average truck on long distance will use 600 litres a day. So if you times that by, 40 odd trucks, it gets up there a bit.
If fuel prices drop, the company will lower transportation costs for its customers, which could filter through to supermarket products.
If you buy a bag of groceries, you're going to have 100 different items in there. Well, then there should be a little save on every item.
Oil prices are hovering around 4-year lows, with Brent crude at $62.5 per barrel. At the pump, the average price of diesel is falling and is now 182.9 cents a litre, while the average petrol price is about 178 cents a litre.
So if you were filling up at a service station like this last year, the average fill is about 50 litres, you were paying just over $100 a tank. Today, if you pull up, you'll be paying just under $90 a tank.
But for many, fuel prices aren't falling quick enough, especially in Broome, where it's more expensive.
Last year it went up to $2.40 and it's kind of stayed at that point.
I've got 2 cars and I use a scooter all the time. It's a lot cheaper.
The cost of fuel is also squeezing Aussies in the NT.
I need to use a lot of petrol, so I need to cut some of the budget in other areas.
She pays about $400 to fill it up out bush. So yeah, pretty expensive. Yeah.
Prices are expected to ease further.
Given that oil contributes about 30% of the price we pay at the pump, you're talking about somewhere between 2 and 3% below where they're currently sitting on an average basis for the remainder of the year.
Oil prices have come under pressure from the US president's tariffs and trade war with China.
These tariffs that Trump has introduced is clearly going to slow down economic activity if they play out as he's suggested. So demand for oil will consequently suffer.
The Organisation of the Petroleum Exporting Countries and its allies are also ramping up supply, pumping out 411,000 extra barrels per day from June to punish Iraq and Kazakhstan for trying to take market share.
Saudi Arabia and OPEC want to see a relatively balanced and stable oil market. And at the moment, they believe that the lack of adherence by some members to their plan is putting that at risk.
The price for Brent crude oil is more than $10 a barrel lower than when the Reserve Bank last issued its economic forecasts in February. If the price holds at this level, it would put downward pressure on inflation, giving the Reserve Bank more room to cut interest rates.
So much of what we buy in our supermarkets and our local shops is distributed by road freight. That's where the big impact will be. And that flows right through to the cost of living, right, for everything.
Relief at a time when many need it most.
Australia's ambassador to the US, Kevin Rudd, has called it a tax on Bluey. This week, US President Donald Trump threatened to slap 100% tariffs on all films produced outside of the US, a move that sent shockwaves through Australia's multi-billion-dollar film industry. The high US dollar has seen a 40% reduction in Hollywood productions over the last 10 years, with around $800 million of that coming to Australia in the last financial year.
Hollywood doesn't do very much. A lot of it's been taken to other countries. They're given financing by other countries. They've given a lot of things, and the industry was decimated.
This despite data showing American-produced movies overwhelmingly dominate the marketplace, enjoying a $15 billion US trade surplus. The White House says no final decision has been made. Competition for mortgage customers is eating into lending margins at the big banks. This week, ANZ, NAB and Westpac reported first half results, following on from CBA's February profit. Combined, the big four have made $15.5 billion after tax in the period. John Story is a bank analyst at UBS. I spoke to him about the results. John Story, welcome to Close of Business.
Thank you, Alicia.
CBA still the clear standout with a $5.1 billion half-year profit. What about the other three?
Yeah, the other three I thought had pretty credible results, actually. All things considered, most of the banks actually met their expectations relative to consensus forecasts. I think what is quite clear in the Australian bank market is that growth is very hard to come by. So if you look at cash earnings growth for all the banks, it was very, very low. Circa 1% on a PCP basis. So I thought the results themselves were good. They were stable. The dividends were in line. And generally, it outlines the resilience, I think, of the Australian banks, certainly within a global context.
Net interest margins, or the income that banks essentially make from lending, were under pressure in that half, CBA excluded. How steep is competition for home loan customers at the moment?
Yeah, Alicia, I still think that competition in the home lending market in Australia is still very, very, very competitive. And you could see that in the performance of the bank's retail divisions, where on aggregate you saw net interest margins for retail banking probably down circa 5%. So competition is still there. It's arguably not as intense, I would argue, as what it was maybe 2 years ago, but clearly still having an impact in terms of net interest margins. And then something we've called out in the past is the competition around deposits, which in our view still looks pretty fierce too.
And what about business lending? Are the others coming for NAB's customers?
Yeah, such a good question, right? We certainly feel like business lending is the next big battleground for the banks, and there's a lot more capital that's starting to push into that sector. And you see increased levels of competition and focus, strategic pivots from the likes of Westpac. You're seeing it from the likes of ANZ. You're seeing it from some of the regional banks. Profitability within business banking from a return on equity standpoint is still at least double what it is in retail. So as long as those types of dynamics hold, we still think that there'll be more competition and more capital moving into that product segment.
You mentioned growth is hard to come by for the banks, but the share prices have run pretty hard this year. CBA, again, the standout, up around 9% year to date compared to a pretty flat market. Can you justify a share price of $167?
I guess it is a hard one to justify. CBA is trading at roughly 27 times or 28 times forward earnings. So certainly within a global context, it is one of the most expensive banks, not just from a developed market perspective, but also from an emerging market perspective of all banking stocks out there, certainly in the UBS coverage universe. It's also, to what you alluded to, it's a bank that's not necessarily growing earnings, but it is very stable. It's got an implied cost of equity of 5%. But certainly in our view, and I think people have thought this for a long time, it does look a little bit overvalued. But we keep saying to clients that, particularly around CBA, there's benchmark risk. It's a $280 billion market cap company. Passive investors need to own it. And it's got natural flow coming in every single month with investors buying CBA shares. So optically, it absolutely does look expensive. But there are reasons, flow and liquidity dynamics that in our view, support the valuation.
There's a bit been written about banks as a safe haven investment in uncertain times, but Australian households are pretty exposed to the global slowdown. They're highly leveraged. How can a bank be a safe haven?
Well, I think the key thing that's changed in the Australian banking landscape, similar to what you've had globally, is regulatory capital has increased for the banks exponentially over the last few years. So they're holding a lot more capital than what they have in previous cycles. Liquidity metrics are very, very strong. And ultimately, that speaks to the stability and the resilience, particularly of the big four banks here in Australia, and actually probably more broadly actually for the broader banking industry in Oz. So yes, they are geared into some cyclical factors. Property prices definitely being one of them. But I think if you look at it from a risk perspective, dynamic LVRs across the bank's lending portfolios are incredibly low. They carry pretty substantial provisioning buffers, and their earnings metrics, their pre-provision operating profit, which gives them the capacity to absorb higher than expected bad debts, in itself is actually very, very strong. So these are stable stocks and stable companies in a very stable banking sector.
John Story, thank you so much.
Thank you very much, Alicia.
To the share market, which ended the week very close to where it started. The ASX 200 index fell a few points and the All Ordinaries index gained a few points. The week ended with Donald Trump's first trade deal since he launched his global tariff war. Despite being hailed as an historic deal by the British Prime Minister, the UK-US deal retained the 10% baseline tariff on the UK. For more, Gemma Dale from NAB Trade joined me. Gemma Dale, there's been quite a lot of fanfare around this UK-US trade deal, but not everyone thinks it's fantastic.
What I want you to do is imagine a plate, maybe it's your dinner, it's got a big steak on it, maybe it's got a big potato on it as well, and you've got a side of peas there. This trade deal might be one of those peas.
So economist Justin Wolfers has essentially dismissed this trade deal. What did the markets make of it?
I love that analogy. That's very funny. It's worth noting the initial reaction was very positive. So we saw the market up. This is the S&P 500 as the news was sort of breaking, up over 1%, very, very strong. It was worth noting toward the close, it did come back quite a bit. It closed up more than 0.5%, but a bit of that initial enthusiasm drifted away as some of the detail became more apparent because, as we all know now, this is an agreement, it's not a deal, and there's a lot to work through.
Is there now a bit of optimism that there'll be more trade deals to come from Trump?
Look, I think it's worth noting that the S&P 500 in particular has regained all of its losses since Liberation Day. It hasn't remade highs, so it's worth noting the highs were back sort of February, early March, prior to sort of the real heat coming into the tariff conversation. It was Liberation Day when we saw those fairly dramatic losses and the market sort of reeling from some of the announcements that were much more significant than they anticipated. All of that has been stripped out now, and we're back to where we started on Liberation Day prior to the announcements being made. So that tells you that the market's feeling relatively positive about what can come. The UK is one of the very few economies, including Australia, where the US actually has a trade surplus. This was low-hanging fruit, and it's one of the ones where you would anticipate pretty easy to get over the line. The big deal is China, but the market's priced for some very good news, I would suggest, at this point in time.
And if that doesn't happen, what do we see?
Yeah, this is the real challenge, right? And also, The S&P 500 was very expensive heading into the beginning of this year. We know that the PE multiple was very much sort of at the top end of the kind of multiples we expect, and the market was anticipating a 10% uplift in earnings for the whole 500. That's pretty extraordinary, and then you start to see these fairly dramatic economic impacts coming through. We've got ports empty of ships and so on, so one has to feel there's some fairly material downside risk, but the market's pretty relaxed about it at the moment.
Well, the Australian share market seems pretty relaxed. It's had a fairly flat finish to the week, not too much action.
Yeah, if you watch the close on Friday and the close this week, almost nothing happened, point to point. Look, it was financials and healthcare where the weakness was, and then we saw strength across the rest of the sectors. And the weakness in financials was 3 of the big 4 reporting this week. Real sort of a little bit of downward pressure on net interest margin in particular, which the market did know about but didn't like anyway. And then the healthcare sector's been under fairly significant pressure for quite some time. CSL's way out in front. It's very much the largest company in that sector, and tariffs are going to have a reasonably significant impact if they go ahead as planned. And so that's really weighing on that stock, which weighs on that sector.
And in terms of company news, this much talked about $3 billion takeover of Domain has actually happened. What are the implications for REA Group, its competitor and its major shareholder, Nine?
Yeah, really good question. Domain was one of those companies that has seen quite fabulous growth, but it's still very much second in market to REA Group. And so REA, you would hope, can maintain its leadership position. The challenge for them is just the possibility that CoStar can put a lot of funding into Domain. They were planning to. That was part of the deal. The deal went through at a 60% premium to the share price prior to the offer, or the interest starting to be announced. So the real question is whether or not they get a lot of funding to start really going after REA. At this point, I don't think anyone's too concerned about that. And then for Nine, they've lost really the highest growth part of their business. That's a concern for them, but they were happy to not give it away, but they were happy to sell it at that price because it was such a premium.
Gemma Dale, thank you so much.
Thank you for having me.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.